We hear some of you, with all that you've just read, asking, my child or children are older. Have we missed the mark on saving for their future using the child millionaire philosophy? Our answer is a definitive no. You have not missed the boat, so to speak, but you do have some catching up to do. Here are some essential facts we want to remind you about using Par Whole Life. Par Whole Life can be a chameleon and will adapt to your needs. If you're starting later, talk to your authorized infinite banking practitioner. Most likely, it is not too late to get set up in a high cash value contract, depending on your financial situation and ability to qualify. Every Par Whole Life policy has two parts, a cash value and a death benefit. The amount of cash available is directly proportional to your inputs. The cash value is the portion you borrow against, and typically you can borrow up to 90% of that cash value. Depending on your goals and timelines, starting later may require you to input greater amounts and/or use the cash value and put it to dual use sooner. The money you borrow doesn't change your cash value on the policy, which will continue to grow and compound uninterrupted. A common question is, can we leverage the cash value before our child turns 18 or needs it for education? Yes, absolutely. Borrowing against the cash value does not impact the compounding of the policy. Policy loans are available by contract, without qualification, and can be used and paid back by the policy owner. A policy loan can be available as early as 30 days after taking out the policy, depending on how the policy is structured and the insurance carrier used. Let's return to the original example of saving $200 a month. Suppose your child, at the age of 20, has heard you tell them about the importance of making their money work for them, and they take a $3,000 loan on their $56,000 estimated cash value of the Par Whole Life policy with the intent to invest. Suppose they place that $3,000 in an investment yielding 6% interest annually. Now they have two funds growing simultaneously using the same original dollars. They are multitasking their money. By retirement, that small investment will pay them over $1 million before tax money. So again, taking something small to add time and compounding, and the money will keep growing, which only benefits your child. In addition, any amount of risk of loss associated with the investment they chose is offset by the guaranteed growth of the Par Whole Life policy that will happen no matter what, by contract.